Well, thank you, ladies and gentlemen, for coming out on a miserable day. We appreciate it. The format will be that Paul Chambers, our CFO, and myself will present the results for the June 2013 year, and then we'll throw it open for questions. Before I do, I won't read you that. The lawyers would prefer if I did. But essentially what that says is that anything in our materials that looks forward or could be construed as being an inducement for anybody to buy Meridian shares has been taken out. And in the context of any questions, anything that is forward-looking, I'm afraid we just will not be able to answer. Clearly, you'd understand that at this point we are in a Securities Act sort of blackout in terms of the information that we can speak about. Albeit, of course, that the government has not made any final decision as to whether it will be proceeding with the IPO with Meridian. All right, on with the results, and I apologise if the lawyers have taken out too many words and it appears a little bit bland and boring. Hopefully it won't be in the future. This year has been a vast improvement on 2009 in terms of all financial metrics. So that's a great result for the company. In terms of EBITDAF, we saw EBITDAF at $585 million, an improvement of 23% on 2012. NPAT, which is over to the right, $295 million, up 296% on the previous year, and aided by certain one-offs, including the sale of our interest in the Macarthur wind farm in Australia. And our underlying profit after tax at $163 million, which was up 53% on the previous year. And of course, you'll all know that we use the underlying net profit after tax to take out all unusuals and one-offs to give analysts in the media a view of our true ongoing position for comparative purposes. One number that isn't there that we are also very pleased about is our operating cash, which at $417 million was up 29% on the previous years. These improved results at the EBITDAF level reflect improved inflows. They were 101% of average, which meant that our generation was up. It was up by just under 10%, 9.8% actually, at 12,071 gigawatt hours. Our hydro was up 11.5%, but actually our wind was down 4.5% on the previous year. So it didn't blow quite as much as we had anticipated. We achieved this in an environment where we still had to manage a number of disruptions in the market, particularly around HVDC outages around the commissioning of Pole 3, and we also had to work out a number of hedges which had been put in place in the prior year, which worked through to the current financial year. If we look at these results in the graphics that Paul has produced here, there are a couple of comments I think that are warranted. The first going across is in terms of transmission costs. Our transmission costs increased by 33%, $29 million, which was quite material. Just about all of that relates to Transpower charges, obviously reflecting the increased work that has gone on in their sphere. In terms of the net profit after tax, that does reflect $101 million of gain on sale from MacArthur. We were a 50% partner in that JV with AGL that was sold in June, and it also does reflect a small profit of approximately $6 million we made from selling energy for industry earlier in the year. And it has about $25 million of impairments, a large part of that reflecting the fact that we have put the North Bank Tunnel project on the Waitaki River system on hold. Over to the right, in terms of the cash flow numbers, as I said, the operating cash was up significantly at $417 million. Our investment expenditure came down in the year, reflecting the fact that the MacArthur build was largely finished. And for the year, our free cash flow, including the interim payment of the interim dividend, was $191 million, which is a very pleasing figure. Our health and safety performance was again very gratifying. I don't like getting up and boasting about health and safety numbers, because the fact that you have not had an LTI for 2 years almost tempts fate and really doesn't tell a true story of whether you are doing a good job in health or safety or not. That said, I think we continue to make cultural improvements on our health and safety scorecard during the year, and it was very pleasing to see the industry forum that was set up by the 5 gentailers, which is looking to improve industry standards, particularly around the way we engage with subcontractors. And anybody that's been involved with anything to do with construction knows that getting subcontractors on board is absolutely crucial to health and safety improvement. As I said before, we had a 101% of historical average in terms of inflows, but it wouldn't be a Meridian annual results presentation unless we bitched and moaned about some aspect of the weather. And in this current year, although we had good inflows in the second half, they were largely bookended. So one was in January and one was in June, and in between we had 15 months of pretty dry weather, which, as you'll see in the next slide, led to some higher prices and a difficult position for us in terms of generation. That said, we finished the year just under the mean position in terms of our Waitaki storage, and as we stand here today, our position is that we are around about 130% of mean in terms of the Waitaki storage. As I said before, we had some disruptions in terms of our market share and pricing, and you can see the effect of some of our HVDC outages. We had 42 outages in the commissioning of Pole 3 during the year, causing considerable spikes in terms of our market share and also pricing. The graph below illustrates the prices through the year, which at the wholesale level were down 36% against the previous year at $63 per megawatt hour. And you can see the effect through the March and April periods of the dry period over the country, the drought, when we saw prices spike. We were lucky to have thermals to ensure we had sufficient output, but that also corresponded with the dry inflows for us in the South Island. As I said before, I mean, our generation for the year was up just under 10% on the previous year. One segment that was particularly pleasing for us during the year was the performance of retail, and it achieved a very credible result, an improvement in terms of just nominal dollars in a period when national demand remained at relatively low levels, as illustrated in the top graph. We're not seeing any significant increase in those demand levels, and most certainly the current year that we've been through saw demand stay relatively flat. That said, the retail business actually improved its performance on an EBITDAF per megawatt hour basis by 63%, increasing profit per megawatt hour to $3.10. Contracted revenue grew by 2.6%, despite there being a 1% reduction in volume and the continued soft demand that I've already commented on. Most of this improvement was through us improving the mix of our retail portfolio. So we had better paying customers as opposed to energy increases. We continued to pass transmission charges on to our customers, but similarly, we, not like some of our competitors, also passed on all the decreases when the Vector announced decreases in its area. Customer changes in terms of absolute numbers during the year declined by 5% in terms of ICPs, and ended the year at $272,000. During the year, we lost a major company in the Wanganui area called EDNZ, and we also completed the transfer of our prepaid customers, largely in the Orion network. Despite this, in the North Island, if you exclude the EDNZ movement, we actually increased our connections by 4%, which, as we've commented on before, is a trend that we are looking to continue. And PowerShop increased its connections by 7%. In terms of the development pipeline, we continued to reshape the pipeline in light of a view that it is unlikely there'll be another major build in the next 3 to 5 years. And the key move that we made was putting North Bank Tunnel on hold, which was adequately reported through the year. On the positive side, we got the Hurunui wind consent, 76 megawatts in North Canterbury, and that consent is for 10 years. So that was a significant win for us, and it was particularly gratifying that we got a 10-year consent as opposed to the more normal 5 years, and probably reflects the sort of time frame that will be required before the project gets built. In terms of our current construction, we're on schedule and on budget at Mill Creek, and I can say the same thing for our Australian project at Mount Mercer. I've commented already on the profit we made on the sale of our 50% interest in MacArthur, and the other initiative that we have going in Australia is that we've just recently launched the PowerShop brand in Victoria. Here's one that you'll probably still want to ask questions about, and I'm not going to really comment on anything on this page other than the final point, which relates to the write-down on the value of our generation assets. Part of our annual revaluation, we reduced the value of our assets by $476 million, gross of deferred tax, reflecting the impact of the renegotiated agreement at Tiwai Point. With that, I'll hand over to Paul for some more detailed comments on the financials, and then we'll take questions.
Thanks, Mark. This is the even more boring bit. Following on from Mark's comments, EBITDAF, as he said, rose by $108 million in the year. The primary driver of that was the increase in our energy margin of $153 million. Now, 125 million of that was in New Zealand, where, as Mark said, we saw better hydrology in the year, although we were constrained by a number of factors, including the dry winter hedges, which we'd taken out in case the dry last year continued. We would have been very pleased to have them if it had, but they obviously cost us something. The constrained HVDC and the 4-month dry spell, which was coincident with the Tekapo Canal outage, so not allowing us to really make full use of our water. The remaining 28 million of the increase in energy margin was in Australia, and that was associated with 5 months of revenue from the MacArthur project prior to it being sold. Those gains in energy margin were offset by some increases in costs, which I'll touch on in a bit. The largest of those, as Mark said, being the increase in the HVDC charges from Transpower. Underlying NPAT, excluding the gain on sale of MacArthur and the non-cash fair value movements, which we always ignore. They were actually positive this year, but I would say please ignore them. They have no impact. It went up by 57 million. That did include the additional interest which we were paying on the debt associated with MacArthur. Obviously, with the sale of MacArthur, that project finance has been fully closed out of. This is just a little diagram for reference, which shows how our margin is constructed in New Zealand. 3 main boxes. One, our contracted revenue, with what we sell to our retail customers throughout the country. What we sell on the hedge market and to NZAS in that second box. Then what we buy from the hedge market to supplement our generation. That number includes 110 million of mandated hedges, which came out of the Energy Industry Act, the virtual asset swap being the largest part of that, and, as I said, some remaining hedges from the dry year of FY12. And then the last box is our net spot exposure, what we do with what's left over after covering our position. And there we had an $87 million number. And this is how those boxes have changed in the year. So the first box, the lift in contracted revenue, comes from 3 sources. One, the better mix in our retail business, which Mark has mentioned, and that's despite quite a degree of pressure in the time of use. That's the large industrial market, which tends to price itself by reference to the ASX traded position, which has dropped off somewhat in the year, and the flat pricing in other markets. The second item has been the increase in sell-side hedges, and that's mainly driven by the ramp-up of the virtual asset swap, which is ramped up over 3 years, and then 6 months of the new, now old, NZAS contract, which obviously had a higher price than the previous contract. The second box, acquired generation, that reflects the fact that we were generating a lot more. We didn't need to buy stuff in order to support our position, and a big positive for us, leaving us with a bit of a gain on net exposure, which is really the balance of bigger volume and lower price. Moving on to costs, you can see the big increase there in the cost of Pole 3 with the completion of that asset, what it means for us. Now, the transmission pricing review is still underway, and we are hopeful that eventually we will see this asset paid for by everyone that benefits from it, rather than just South Island generators. But at the moment, we are taking the lion's share of that cost. On our other costs, we, as Mark mentioned, had a couple of one-offs. One, the IPO process costs, and now they're a matter of public record, put out there by the government, so I won't comment on those. There are also some costs which were expensed relating to our pipeline development, similar to the below-the-line write-offs, but items which had never been capitalised. And the final item was obviously with the bulk of our employees having an at-risk component to their income, we had a far better result. We accrued for a level of bonus this year for those employees. If you strip all that out, actually our underlying cost was slightly down on last year. And that's a reasonably good performance in what is a very competitive retail market, demands a lot of cost to keep customers loyal and to attract new ones. The last slide that I've got here is on cash flow. Obviously, with a 29% increase in operating cash flow and decreased investment expenditure, we're in a good position to support the dividend of 252 million, which was a significant increase on last year, and that was paid out as a result of our good underlying profit and the profit made on the sale of MacArthur. Given that we pay down a significant chunk of the MacArthur project financing, we also end the year with a much reduced debt position. I think that's probably it. I'll hand over to Mark now for just some final points.
Thanks, Paul. So, look, in summary, a significant improvement on 2012 on all metrics, profit and cash. We had improvement in our hydrology inflows to at least average, which was a far cry on the previous year. We saw continued improvement in our retail business, which we've spoken about before. A couple of milestones. One was completion of the HVDC commissioning. It may have given us a bit of jip through the process, 42 days of outages, something like double what was originally contemplated, but it's a fantastic milestone to have that completed. And finally, completing the TY Point deal, which took some 13 months and diverted a lot of management time to completion. Sorting that out in the financial year was a major milestone for us. So with that, I will throw the floor open to questions. Claire has got a microphone. I would just remind you that I'm not being evasive. I might just be dull and boring with regards to any answers I can give you with regards to forward-looking questions.
Hi, Jason Krupp from the Dominion Post. Quite a few analysts have described the TY deal as kicking the can down the road. From your perspective, why should shareholders take any confidence from the 2-year extension that essentially you've given to the deal, at which is the earliest point that TY's owners can signal that they want to close the plant?
Well, the first point is, the length of the extension when we were doing this negotiation. That the existing contract might not have been the counterfactual that we were looking at. You can have, I think I said at the last media, you can have an iron cast contract, but with a counterparty that is not so ironclad, if you like. So the counterfactual that we were looking at might not have been that they were going to be there to the end of their contractual period. That's point number one. Point number two would be that the structure that we now have around electricity pricing, we believe is very competitive internationally. Now, of course, I dare say if you went and asked New Zealand aluminium smelters the question, they would say that it's still too high. But from our point of view, we believe it is competitive, and we believe it offers a structure that is capable to see the contract through to 2030. You've got to remember that New Zealand aluminium smelters, Pacific Aluminium, Rio Tinto, put a huge amount of time and effort into renegotiating this contract. I don't think they would have done so if it was in a hopeless point on the cost curve where they thought it was basically a dead man walking. They clearly wanted to save the smelter, and we believe there's a lot of operating leverage to the upside if either the aluminium price, international aluminium price increases, or the New Zealand dollar decreases against the US dollar. So, we're not negative that they're necessarily going to go in 2017, but conversely, we don't know.
Why was the write-down on the TY deal not taken through the profit and loss statement?
I'll let the CFO answer that.
It's a reversal of previous revaluations, so it goes through the revaluation reserve. That's just the accounting standard.
Can you just explain the qualification around deferred tax liability around that?
Yeah, when you revalue assets upwards, you also introduce a deferred tax balance for the tax percentage on that revaluation upwards. Again, that's part of the accounting standards. So clearly, if you revalue downwards, you reverse some of that. So you reverse 28% of that 476. So the net figure comes up with 300 and something.
Mark, with respect to the dividend, is it fair to assume that the 101 million from MacArthur is all paid out in this dividend? And if that's the case, what does that mean about your underlying level of dividend payout? What's that as a cents per share?
Well, do you want to comment, Paul, on the MacArthur?
I know you can't look into the future, but I'm trying to get a sense of what your full dividend now looks like compared to your previous years.
So on MacArthur, so our dividend, we've paid out in line with our dividend policy. We've paid out 100% of adjusted NPAT, which is underlying NPAT, plus another couple of very small items. So we've paid out in full the profit on sale of MacArthur, including tax impacts of that as well. As to sort of future dividend policy, obviously that's not something we can comment on in the current process.
That would all be disclosed, Patrick, as you know, in any prospectus if the government decides to proceed.
Can you give us a bit of a guide as to what sort of dollar impact the HVDC outages and the TECPO work had? I mean, presumably there's some numbers around as to what sort of impact that had.
Paul,
look, normally we'd give some estimates, but I think again, given where we're at, and given that they would be very round sum estimates, we're not going to quote numbers. Suffice to say that every day that you have an outage, you see some reduction in revenue and some requirement to take hedge cover to support your position. In terms of the Tekabo Canal outage, you can probably do the maths yourself in terms of what inflows we would have missed out on over that period and what that means in terms of volume.
How much?
Very, very difficult to work out. The numbers that I've seen, I mean, I think are just too rough to really share with people.
How much money have you spent on preparing for the partial float?
I think that the amount that we have spent to date gets
it's all publicly disclosed. So I think there's a quarterly public disclosure, which would be, I'm not sure which government website it's on actually.
I'm sure that's
it's on Treasury. It's on Treasury's website. So there's a quarterly disclosure for all parties.
That was in our last quarterly number that went out just a few days ago, wasn't it, Owen? It wasn't. Okay. When was the last quarter? When was it?
March quarter, Treasury made the disclosure. I expect their June disclosure there.
So you've got a good idea of where we were in March and a bit more to June.
What's the deal with Transpower? If they tell you they're going to take 21 days and they take 42, can you go after them?
No.
For some compensation on that?
No.
No.
It's all care, no responsibility, Patrick.
Why is that?
Well, usually happens when you're a business that's the big M. Monopoly.
So you've got no capacity to negotiate that away?
No. I mean, if you were sitting in Transpower's shoes, I mean, you would say, well, look, do you want it or don't you? I think it's reasonable. They'd say, look, this is our best endeavours. This is construction. We can't give you any undertakings. We'll work with you, which they did. But, we weren't in a position where we could demand guarantees.
Can you explain how this lay-by shareholding is going to work?
No.
Why not?
Because it's forward-looking and it assumes that's exactly what the government's going to do, and the government hasn't even made a decision that it's going to proceed at this point. So I'll be getting far ahead of myself to talk about any offer structure, which is for the Crown to talk to the press about.
the adjustment that's been made for the NZAS deal, does that capture all of the deal? I mean, the deal was signed in August. Is there any further adjustment next year?
There's a very minor change on the actual CFD accounting, which the residual value that was sitting in the balance sheet was about 10 million, and that would be expected to go to zero on day one. But all of the generation asset impact has been taken through.
About these forward-looking statements, aren't your lead managers already out there talking to fund managers about all the financials, etc.?
Well, they're not, Ruth. Sorry, Ginny. The JLMs aren't our lead managers. They're the Crown's. So I don't know what they are talking to fund managers about. I mean, there might be some market testing going on. I don't know. But they're not our responsibility. We just do as we're told.
You mean you're really kept in the dark about all that?
Well, we know what's going on, but we don't call the shots. Any more questions?
Just one on Australia.
Yep.
I'm now struggling to remember what the heck it was, but there was some Australian Financial Review speculation that you might be looking at another MacArthur Mount Mercer style involvement over there. Is there anything in the pipeline?
That report was very misleading, and the answer to that is no. I mean, we do have a very small option on a small hydro in Queensland called Burdekin, but that option, Patrick, has a 10-year date on it, and I mean really reflects what we're trying to do in Australasia, that is have long-dated options, given the view we have on the market in New Zealand and Australia.